Ladies and gentlemen, welcome back to DriveTime. It's our educational podcast series. As many of you may be in the car, so if you're in the car or you may want to listen to this again, the great part about this little series is you've got the ability to go back, take some notes, listen, and hopefully we can provide you with one or two little golden nuggets to add to your current leadership or management style. DriveTime is thanks to Professional Partners Education and our major supporter, Hall Chadwick, and our other supporters, Profit Master, iKeep, and Lloyd's Auctioneers. Now, I'm always excited to chat to new guests, and some of the information that I've shared in the past, whether that's through my live shows where I've been talking in that advisory space, or certainly through my other podcasts, whether it's Talking Numbers or whether it's DriveTime as well. We've always tried to give all of our listeners more information, certainly our accountants, the ability to think a little bit different. A lot of the firms that I've worked with in the past, I've challenged them to think about what is advisory. And while we've gone through this over the last 2 or 3 years, a lot of them still get confused to what advisory is. And we're going to take a different look at this today. Let me introduce you to my guest. I'm chatting to Ben Broadbent today. Ben, welcome to DriveTime. How are you?
Yeah, excellent, Paul. Thanks very much for the invitation.
Yeah, it's my pleasure, mate. And today we're going to tackle the topic of debt advisory. And I think, again, a different way to look at this a little bit more. But, mate, let's start off with you. Let's give everyone listening to this a little bit of a feel for who is Ben Broadbent. Mate, share a little bit about you, if that's okay.
Yeah, no worries. Thanks for that. Well, I suppose I consider myself to be a little bit of the accidental banker, if you like. I commenced part-time work in the sports industry going back a number of years, and I needed to fill in the days with something to keep me busy, and commenced work with NAB as a bank teller. And so it didn't take me long to certainly enjoy the customer service aspect of that job. And I made the switch after a couple of years into the business banking team, which is very much a relationship-based model, and certainly found that particularly rewarding. So my career there sort of took off, and I spent the subsequent 18 years in customer-facing relationship-based roles, and including leadership. Got around the country a bit, time in Townsville, Brisbane, Melbourne, and Darwin during that time, and since leaving, have joined a group called Hyaline Finance, where as a debt advisory principal, and sort of coming up 2 years with the firm there. So that's been a great time working with the Jansz there, who have sort of leveraged their strengths and been able to bring some of my own sort of flair to the table as well with the group. At a personal level, married to my wife Carly, we've got 3 very active boys who, like their parents, love their sport, and so we spend a lot of our weeknights and weekends ferreting them to and from training and games for football and basketball.
Yeah, brilliant. We've got a little bit in common there with my 3 boys as well. So I think, yes, footy and basketball tends to dominate, doesn't it? Mate, let's get into. Thanks for sharing a little bit about that. Let's get into this advisory side. Let me drill down a little bit more, because I suppose the advisory bit is an interesting one when it's the advisory debt. I think is an interesting term. Sorry, because I've always thought about. Let's say, and you said banking. So when you say banking and NAB, my brain goes towards mortgage broker and how people are assisting, I suppose brokers are assisting individuals with their mortgages, because that's what most of us have to own our beautiful homes. So tell me a little bit about how you differentiate yourself from, let's say, a mortgage broker.
Yeah. So certainly what we do is we essentially consider ourselves to be what we call freelance business bankers. And in that, we're not wedded to any one particular bank or lender in terms of how we can assist a client. So it does bring a good level of diversification there. So we're certainly focused on developing those long-term relationships with the clients and working in conjunction with other advisors through that process, which would, certainly includes accountants who we work closely with. And what we're looking to help clients navigate is that debt procurement sort of process. So where we start to look at that is that we've got the experience, if you like, in the breadth across business loans. So we've got the cash flow on balance sheet sort of lending piece there. You then look at, it extends into commercial property, equipment finance, and then we do manage the home lending piece for our clients as well. You sort of touched on a little bit there with regards to the mortgage brokers. They'll traditionally work with the PAYG sort of client with their home lending sort of needs and buying a family home, setting up a home loan there that is really a transaction that's set and forget in some respects, because it's rare. We don't move homes that often, sort of thing. And as long as mortgage brokers will often do a great job around just managing expectations on the type of home loan facility they got, pricing, and sort of look to review that for their clients over time. What we look to do is target sort of SMEs and mid corporates, and then assist them with the sort of full suite of debt products via bank and non-bank lenders that are certainly in the market these days. So the value add that we see sort of comes from the depth of experience, including the level of support that we can call upon from our colleagues within our own particular sort of group. And we obviously look to get those outcomes for clients. And what we find, and this is probably where we sort of really push into the advisory sort of space, is getting brought into the conversation with clients at that sort of, I would call it like an embryonic sort of stage of a particular sort of business or investment strategy that they might be looking to undertake. And where we can assist there is sort of looking at the lending element and sort of the key aspects of a particular transaction and how a banker or lender may view that, so that we can provide some guidance up front for the client and help them determine whether it's what sort of cash or equity they might need to bring to the transaction, and the sorts of funding solutions that they may be able to achieve with that. So another key component that starts to creep in there is making sure that they've considered what else, if you like, goes into the mix. And sort of we talk about what other sort of consultants or authorities may need to be engaged for input or support or approvals to actually help them pursue that opportunity. So if I just to give you like a bit of an outline, say as an example in sort of property, someone that's looking at, say, an investment property, or they might be looking to do a knockdown and build a few units on a particular sort of block of land. Who else, is a client that's relatively new to that process, aware of the other factors that are sort of involved there, and have they spoken with their architect, with the engineers? Have they considered what the local sort of council and government sort of guidelines are? There's environmental and energy sort of considerations now around sort of the carbon sort of neutral and that type of thing. We then step into the process around sort of valuers that need to come in and ascertain the validity of the development. Do we need a real estate agent to come in because we're going to look to sell? Where are we at with our builders? Have we considered our legal obligations in regards to the contracts of sale if we're looking to sell some of those properties? So what we find is that for those clients that maybe don't consider and consult with those other parties up front, they can spend a lot of time and energy and sometimes dollars, because they'll commit to a transaction before they've done that level of due diligence. And then ultimately they can get a poor outcome because they haven't maybe got the full spectrum of sort of what's involved in that process. So where we really pride ourselves is really around in the advisory sort of piece, is saying, hey, we handle the debt procurement sort of element for you, but in terms of achieving the best outcome for you as a client, we need to ensure that you've considered these other functions and factors that make up that full opportunity that they're exploring.
Yeah, brilliant. And look, what I love of what you just mentioned just then, and for everyone listening, that's been a part of my Talking Numbers series or my Chewing the Accounting Pat live shows, or even my Empire Masterclass at the moment, where we delve a little bit deeper into what advisory is, because, certainly being in the industry, and I mentioned this before, a lot of people still get a little bit confused to what is advisory. But one of the key things that I just wrote down then is you ask questions. And I think advisory is about that. It's about asking those deeper questions to what could affect the particular transaction. And that's where, is that fair to assume that's where your advisory skills come into it?
Yeah, I think, and that's what we seek to probe and understand, essentially, at the end of the day. And because what we don't want to do is get caught, or have a client get caught in a situation that they sort of go, geez, I'm really stuck here.
Yes.
I'm really struggling now I can't do what I wanted to do initially.
And if they're committed financially,
that's right. If
that's
you've already,
problem.
so you're then trying to potentially come out of a contract if it's a
Exactly.
sale, if you've negotiated a supply agreement, hypothetically, and some terms around that supply agreement with that supplier, and you can't fulfil the obligations of that, then you're up for some you've got some challenge there as well. So it's just important to and this isn't to. We're not seeking to curb the enthusiasm of someone to try and achieve a great outcome, but we're mindful of being really transparent and upfront and saying, well, these are the considerations and potential hurdles and challenges that need to be considered before you get to that ultimate outcome that you're looking for.
Brilliant. And the funny part is that, and you mentioned it before, so we'll delve a little bit deeper into this. And for everyone listening, it's I'm learning as well, because this is really, really important. You sort of mentioned two key areas there. You mentioned early on, you said PAYG, which is important, those mortgage brokers, and you said you really work in the space of the SME corporates. And I think that's a really important one, because they're it's not to say the PAYG can't be entrepreneurial, but it's more the SME corporate that is more likely to, exactly what you said before, maybe look to buy a commercial property for their business and then look at, well, I can't go out, so I need to go up. And then what are all the considerations that may need to take into consideration? Like you just said, if you want to put another 3 levels on there and build a certain business or residential, is it zoning? There's all sorts of different aspects that you need to consider, isn't there?
Absolutely, yeah. So and that's where we don't subscribe to being experts in those other particular fields, but we're being experienced in the sort of debt procurement process. We're well aware of sort of a number of the key items that need to go into that piece and that funding mix, and that's the experience that comes from dealing with the banks and the lenders to know what they require. And without being, we reflect on this at different times, and you'd see this in work you do, Paul, is that we don't know what we don't know, sort of thing. So, and that's where that, I think, a critical element of that advisory sort of piece comes into it. Is we're just trying to ensure that people are well versed with all the considerations that need to be factored into the next step that they take. Yeah,
brilliant, love it. Now let's move a little bit into what you just mentioned before in terms of equity. Let's talk about debt versus equity. Tell me, how do you go about qualifying to borrow money, or if you need an injection of capital into the business?
Yeah, so I think the key element here is that we discuss with clients to assess and gather information and discuss and assess whether what they're looking for is a bankable proposition that sort of fits within the bank's risk appetite, or are they essentially asking the lender to take on what is considered to be equity sort of risk? So what we sort of, and some things around that are around sort of in terms of risk. If I use this sort of analogy, a debt provider has upside that's essentially sort of capped, so that they won't they'll get a return on it, but it's not going to be, they're going to shoot the lights out as such. But their downside could be loss, but they're always looking to sort of mitigate what that loss could be. On the flip side, you've got an equity provider where ordinarily you put equity in, the upside is unlimited. There is, whatever, as far as you can take it, so that you can participate in what that upside is. The downside is that you could end up with nothing. Because that's what equity is. You're putting everything you're putting your equity in, and you haven't really got any. You don't necessarily have this security blanket, if you like, sort of sitting in behind it to sort of go, hey, if it'll stop here, sort of thing. So, where we go with that is that the debt providers, being your bank and your non-bank lenders, will always seek to mitigate the downside via proven cash flow or a level of security. Now, the level of risk that they make, that particularly from the banks that they undertake is governed by the risk appetite that they sort of determine themselves, but it's also shaped by a number of market forces and also the regulatory sort of bodies. So from a regulatory point of view, banks are under direction not to take on risk outside of their sort of remit, if you like. And when you think about that, they've got to protect their balance sheet. A lot of the balance sheet of banks and lenders is funded by deposit clients. So they've got a duty of care to ensure that they don't take on too much risk where money's lost, and therefore they can't return, funds to their deposit sort of clients. And through that process, the banks are always looking to try and maintain stability and confidence in the banking system, sort of thing. So if you think about, we go back a number of years, we had the state bank sort of failures, we hit the GFC, we've gone through this we're even just the current sort of state of play now. There's this, we look at bank profits, if you like, when they get released, by the big four and that sort of thing. You go, have a look at the number, but you go, we need to sort of temper that sort of, hey, why do they make so much money by also the virtue of the fact that, well, hang on, if they weren't making strong sort of profits, sort of thing, that would undermine their ability to manage risk, if you like, and returns, and then puts a massive strain on the investment sort of market as well, because of the number of investors that would have either bank shares through either directly or through their superannuation or the deposit type clients as well. So again, it's really important that the balance sheet of the banks is solid, so that they can continue to lend money and sort of support the economic sort of factors that are at play as well for clients. And the banks are sort of reasonably highly geared businesses, so it's high volume, lower margins. There's not a lot of room for loss that sort of comes into that. So important again that that they maintain a level of integrity around that sort of their debt profile, if you like, and their risk appetite. So when we sort of look at the two components of whether are we a client that can achieve a debt outcome, or we're more likely to need equity at this sort of point in time.
Yes.
If we look at the debt side of it, things that are considered, from a management point of view, have they done this before? Did they make it profitable? Was it in a similar location? Was it done at a similar sort of scale? Have they got a strong industry position? Have they got many sort of customers and suppliers? And what's the certainty around sort of their recurring cash flow to be able to sort of service and repay that debt if we take that on? Yeah. Conversely, from an equity sort of point of view, if we're thinking about a new business or a new product, a new location, a new process, it hasn't yet been profitable. There's only a few customers or suppliers at the moment within what they're doing, or their industry position isn't, super strong just yet. The more likely outcome is that we're going to need some equity to sort of firm up those items before we then shift and can change focus to look at a debt solution that might be able to come into play there.
Right. Okay. Right. So again, there's a number of key things in there to consider, and that's probably the great thing about, being, you're probably an accountant, you've probably got some clients that may be going through these sorts of challenges, and this is the great thing about, again, to a certain degree, sticking to your lane and working with your clients and asking certain questions, but then bringing in experts that may have greater knowledge in these areas, because that's the consultancy side, that's the advisory side, which is brilliant.
Yeah,
but,
absolutely.
I've heard you talk about this before, and I know you've spoken to a CPA group that I'm a part of. But tell me a little bit about the 5 C's. What are they?
Yeah, so this is sort of, if you like, we use the term, it's a classic lens through which the banks will assess their risk, and it's around their credit analysis that they undertake. And those 5 C's stand for character, capacity, capital, collateral, and conditions. And they generally most banks and lenders will work through in that sort of order, if you like, sort of the way that they assess a transaction or an opportunity. So, from a character sort of point of view, does the transaction make sense? Is the purpose sort of legal and on strategy with what the client's been done historically, or if there's a change of direction that makes sense in terms of how they're sort of going to go through that. Management depth, integrity, experience, ability, and then you've got the performance piece that we sort of spoke about before in regards to the debt sort of element. Capacity, again, the borrowers sort of has generating sufficient cash flows to repay the debt over a commercially appropriate sort of time. The key element in the capacity sort of piece is understanding cash versus profit. sort of thing. And whilst our accounting colleagues would certainly be aware of the difference in those sort of factors, and the banks and the lenders do very much delve into that as well. So, underpinning that cash flow sort of moving forward versus just looking at a profit line on a P&L, there's always a need to delve into that a little bit more. So the capital piece, and that comes back to the earlier sort of points I raised around the debt to equity sort of risk. What's an appropriate sort of gearing level at that point for a particular client at a point in time with the transaction that they're undertaking. Is the leverage reasonable? That debt to, we use the term sort of debt to EBITDA, how many times, sort of the debt is the debt over sort of that EBITDA sort of position. It sort of just helps support the repayment sort of capabilities sort of thing, because again, it's based on sustainable earnings over a period of time.
Yep.
The collateral is about that is, generally speaking, is the secondary source of repayment that we're looking at. So if we talk specifically about a property development transaction, then absolutely the source of repayment's the sale of that apartment being one of 10, at the end of the development. But for traditional sort of business lending, we're looking at the cash flow of the business first and foremost, and then we're looking at, okay, in the event that fails, what other collateral is there available to ensure that the debt gets repaid? So that sort of sits in there. And then we come down to conditions, which just is around, what are you after, but then how are you after it? So we've got, term, interest only, P&I. Do we then need, based on what you're looking for, is there a level of reporting and obligations from, management accounts, end of financial year accounts, assessing gearing levels, ongoing, ensuring pricing's right, financial covenants and leverage sort of ratios. So those items start to come into it, into that sort of, at that final sort of piece as well.
Okay, so that is very, very comprehensive. Just a little bit of those 5 C's are very, very good, and something for all of you guys that are listening to this, the ability to think about that, and also if you're starting that conversation with your clients, even before you even chat to Ben or someone like Ben, is you can start chatting to them about that, and whether it's character, whether it's capacity, whether it's capital, whether it's collateral, whether it's conditions, all those critical factors are going to be playing a major role in an outcome, I suppose. And we always want a positive outcome if you're working for your client. So again, that's where, just harping on this a little bit, but that's where the advisory piece really comes into it, where you're working with your client. You're effectively trying to work with your client to create greater wealth, greater opportunities. That's why most of us do it. If we're looking at a property to buy that's got a dual dwelling commercial with a living space out the back, and you want to go up, well, you're doing that really to create more assets, you create more wealth. So never fall short, for all of you listening, never fall short of just asking the questions to your client, because that'll then delve a little bit deeper, and you can go into the different areas that you feel you need to bring in expertise, which is what we've always said in all of our advisory pieces. Ben, I suppose there's always been a challenge between, let's call it language, with banks and lenders. Call it Portuguese versus Spanish. What can you share when it comes to this?
Yeah, so look, it's an interesting sort of conundrum, because you can. That's basically what it can feel like sometimes. When you're saying one thing, but the other party's hearing something different, sort of thing, and that's the part of the role that we play is to complete that interpretation, if you like, from the client to the bank or the lender. And so, some classic sort of examples for us is, the client says, "Hey, sales are up 20%." And then the bank goes, "Great, but so are your debtors. So how are you going to fund that?" Sort of thing. So, all our creditors are paid within 30 days. Oh, so is that why your overdraft is so high? So, we're looking at buying a complementary business. Great. It sounds like it could be a good opportunity, but will it be a distraction? Will you actually be able to realise the synergies that you think, or have you appropriately sort of analysed that? Our customers are asking us to support them offshore. Well, do you know what that market is? Do you know how to then manage the FX, the exchange rate sort of component that's in play there? We've exited, a handful of staff to save costs. Right. So does that mean the business is in trouble, or is that actually just you were over leveraged with your personnel?
Interesting.
Sort of thing. So again, it's just mindful that the client all of these things can be really positive elements for a client. And what we're looking to do in our role is make sure that in the translation of that to the bank is the bank understands the purpose and reality behind why such decisions are made, or where the business has gone strategically and the outcomes that are then flowing off the back of that, so that there's not a misinterpretation, if you like, of the language.
Yeah, it's a good point. You mentioned a story there. Is there anything else that you can share in terms of other practical examples or stories, that you can share with our listeners? Again, I think personally, I can resonate more with exactly what you're saying, because there are situations, like even in my brain, that I know is going on at the moment with some of the stuff that I'm looking to do, where it's like, okay,
yeah, right.
And the sort of what you said before is, and it's a great term that keeps coming up for me. What you don't know, you don't know. So you go down this road, and at the end of the day, you maybe go down this road a little bit too early, because what you don't know. So, is there any other sort of practical examples or stories you could share?
Yeah, look, I think I've worked with a startup client actually for probably about 20 months now, and his is a great story. He's a guy that has a bit of he's more of a sort of chippy sort of background, if you like, for want of another phrase. Spent time working on infrastructure sites for sort of roadways and that type of thing for a number of years. And where he saw an opportunity was just in regards to the way their staff were looked after, the different, the team rooms and the sort of the amenities, if you like, that they were housed in out on site and that type of thing. And so, he's sort of stepped into that space to produce his own unit, if you like. And but the beauty of him, and when I met him, was to say, he already had sort of got 5 units up and going, and so he'd invested that equity sort of piece first up, and has tested the market. Because of his contacts in the industry, has been able to gather a few clients to sort of kick it off. And we talked about, well, how do we start to leverage? Is there an intrinsic value in the actual tangible asset that he's produced? And can we get a valuer and a bank to appreciate that? And so we had to look at, okay, well, what's the market value if we could, if we're able to sell it, to a party that wanted to invest in it. But then also if we had to liquidate it, and just moving on, how does that diminish the value? What's the likelihood of success in terms of him continuing to be able to produce this unit or these units ongoing, supply them, have customers sort of take them up, and then be able to service them sort of through that process. So we had to work through quite a diligent sort of understanding in terms of modelling and forecasting, and getting comfort around the opportunity in terms of his client base. And so where that was, we're working off the back of sort of infrastructure projects that, and government spend, and, where different agencies are at with regards to timing, and need for these sort of units. And the beauty of the outcome there, where we got to, and is that we were able to put together a banking submission that really pulled all that together and give comfort to the bank that this guy knows what he's doing. He has actually put some equity in. He's gone and tested the market. It stacks up. We've got a secondary exit. That position that we know is sound, and our forecasting in terms of financial performance is solid because we know where the opportunities are going to come from, and we've already got some of those clients on board. So we were ultimately able to get essentially a construction facility that supports him being able to fund his inputs for the construction element, which then means he's been able to produce more and more units. And so the growth in that group has gone from sort of when I met, so in the space of 20 months, we've probably brought about, we started with 5 and we're now at about 21 to 22 units to market that are all operating and sort of in the marketplace. And so that's been a really cool story where we've spent the time to actually understand and delve and ask those questions, work with the other advisors to him, understand the marketplace, and then being able to translate what his goal is, if you like, or what his dream is, into a bankable transaction and get a really strong outcome for him. So that's meant that he's been able to continue to grow his business and service his client base, who are becoming, if you like, more and more hungry for the product as well.
Spot on. No, and I'm sure there'll be, there's, I suppose, for everyone listening, there's always clients. I suppose most firms averaging, I don't know, probably 500 clients, number of SMEs within that client base. It's not just about doing, again, because I've got a lot of friends that run businesses, and it's not about, they often ask me about, I have someone that does my accounts, and nowadays our accounts they're simple. They're a lot simpler to run through Xero or through MyOb, and everything's in the cloud and things. That is not what clients are looking for. They're after someone to help them with exactly what you said. How do I go from 0 to 22 in 20 months? And I think that's a really interesting point to, for all of you listening, also just to challenge yourself. Am I having those conversations with my clients? Am I actually getting to think a little bit bigger and outside the square to, can they do this? And then getting involved with someone like you to say, can we actually do this? What does it look like? Which to me excites me. It's sort of one of those things that's what drives me. So I know there'd be similar SMEs, entrepreneurs out there that would be thinking similar, but sometimes they need to be propped by their accountant that's out there actually asking them the questions. Mate, so how do you operate? So let's talk sort of debt advisory, and I've got one last question before we wrap up, but how do you operate as such?
Yeah, so look, from that introductory sort of phase, what we're looking to do is just understand the client's business goals and strategies, understand their needs. We then get some data, if you like, in to analyse and determine if they, what they, the considerations and factors that are going to influence what they're after. And then from there, we can determine the sort of the options and the alternatives for a financial solution that sort of meets those needs. We put together a financing proposal for the client, and that'll be a synopsis of our recommendation, but it'll include the solution, the risks of the transaction, mitigants to those, just the staging and structuring of any sort of the debt profile, the probable loan and security structures, terms, conditions, pricing. That'll all sort of be outlined there, including the scope of work and a timetable to sort of get all that done. And then we supplement that with an appointment letter. And if the client likes what they see in terms of sort of, our having a good understanding of that's the outcome that we can achieve for them, then they sign off on that appointment. Now, we work on a success fee basis, in the sense that we must deliver materially in line with what we've said we're going to do in order for our fee to become sort of due and payable. So up until that point, we're fully speculative in our work at that sort of point in time. So if I take the previous sort of client, so with the previous client, I probably spent about 2 to 3 months working with him and understanding and gathering and pulling everything together before we formally approached a lender. From there, we were able to obviously get the outcome that we were looking for. But again, my role, my fee, success based. So that's the work that we back ourselves in, if you like. And But by the same token, we'll be really clear up front with the client if we don't believe that there's an outcome that can be achieved based on the information they're providing. So we're not going to ask a client to go through the ringer and provide a truckload of data for us to view just for the sake of it, just to satisfy our own sort of curiosity, if you like,
that's exactly right.
That sort of process. So,
what I like about that is that's what most SMEs will be looking for as well. That's like to be fair, we're going, well, ask us a certain amount of data. If we can't, if we feel, and that's where experience comes into it, you'd go, guys, I don't think this is going to fly, and then you've got the ability, but if you think it can fly, well, the client sits back and goes, oh, okay, well, they're doing a lot of the work for me.
Absolutely, yeah. That's on us, and then we allow them to, I think the big thing in that process is that we allow them to concentrate on what they do best, which is running their business, and not be distracted by the finance and funding sort of piece.
Clever. Love it.
Yeah.
Mate, in wrapping up, let's call it, I don't know, I always like to leave, whether my podcast, like to leave something for last, though, in terms of a piece of advice that you could provide our listeners with, that could possibly start raising certain questions with their clients to identify a need. What do you think is as in terms of a piece of advice?
Yeah, look, probably the number one thing I'd say is listen in for clues from the client around dissatisfaction, if you like, around sort of the debt or banking or finance sort of piece that they've got in play at the moment. So often when we speak to clients, they go, oh, the bank's done this or the lender's done that, or now they want to do this. So there's normally some level of trigger that the client sort of feels first before maybe even an advisor or an accountant sort of even asks a question sort of thing. So I always keep an ear to the ground for that sort of dissatisfaction or frustration in that sort of finance piece. But look, a couple of things. If they're looking for additional finance, for capital investment, working capital growth, merger acquisition, something like that. The other thing that we always speak to is health checks. And so you come back to you don't know what you don't know. The bank, the client might not know that they've been taken for a little bit for a ride. The bank may have been a little bit lazy in sort of just actually they've set up a structure based on a client that was in its infancy, and that was sort of 5 years ago, and yet we've still got the same level of security, we've got the same repayment structure, we've got the same price, yet the risk profile is significantly reduced because the business is now 5 years older and has delivered consistent year on year sort of profitable results. That sort of dictates that our risk profile, as it was on day one, is far less than it is now, 5 years later. And what that can enable us is to reduce amortization of debt, improve pricing, maybe reduce the level of security that's required to support it. So even those factors can provide a real element of peace of mind for a client to sort of go, hey, I've said I will do something, you backed me,
yes,
but now you're saying you still need everything, even though the debt level's only a quarter of what it was sort of 5 years ago. And so we often will get called into those sort of situations where we can support the approach to the bank to change up and get that more in line with sort of current market expectations and current expectation based on what the client's been delivering over an extended period of time.
Yeah, fair call. Look, and I think just in from my just a final word there. I think if you guys as accountants are thinking about getting out there, and again, a lot of people say to me, like, we don't know where to start. We don't know how to sell this. We don't know how to market this. We're not asking you to sell it. We're not asking you to market it. We're asking you to get out there and ask questions, and the answers will usually deliver some sort of an outcome. So always think about that. And the one thing that Ben just mentioned there, it's an easy one to ask to start with. Tell me what you're not happy with. Okay, so society tends to go towards the negative than the positive. So people will often go, well, I don't really know what I'm happy with, but I'll tell you what I'm not happy with. And then bang, they can outline that. And then you can say, well, what about from a banking lending point of view? What are you not happy with? And that could uncover some key information as well. So that's always a really, really good question to start with your clients if you're thinking about where do I start. So please always think about that as a starting point. And Ben mentioned it before. Ben, let's wrap up, mate. Thank you very much. It's always refreshing to hear people sharing their knowledge, their expertise, stories, all from different angles. And I think, again, this series of DriveTime, it's an educational series. Professional Partners Education is about providing continual education back to our accountants, and that's what we're looking to do. So I certainly appreciate everything that you've shared with everyone listening. So thanks, mate. I really appreciate it. To all of you that are listening, thanks for joining us. Thanks for listening to another episode of DriveTime. Like I mentioned before, go back, listen to it, share it, get your other team members involved, because this is priceless educational content that doesn't cost you anything. And to be fair, we're always looking to learn and improve our skills. So if we can do that with all the different guests that we're bringing on board, we hopefully provide you with, I said this at the start, 1 or 2 little golden nuggets. I think Ben's probably shared about 10 there. So go back and hopefully that can work for your business moving forward. Ben, thanks for joining us again, mate.
Pleasure, Paul. Appreciate the invitation, as I said. Fantastic.
My pleasure. Thanks for joining us and enjoy the rest of your day.